Hello, Oak Bloke here, and just thought I'd record one last video before I go on holiday. So just thought I'd chat about a few ideas that and things that have occurred to me. So this morning I wrote about CAML, Central Asian Metals, which I thought should be renamed Central Arizona Metals, seeing as that's where they are seeking to buy a new project. That one, really good economics. So the original, this was the original uh, PFS, so 4 billion, 4 billion of resources, and because prices have changed and because they are revising that estimate, it's crept up from 4 billion to 5.8 billion dollars, US dollars. So obviously pretty impressive numbers. Now it's not a done deal. They've raised the bid. They're now 9 million ahead of the next bidder, so it's looking reasonably likely or reasonably certain that they are going to get this project. It does need development. There's still a DFS, so again there are further steps, but not many. I mean, they can start groundworks this year. They can start construction next year. They would have it producing early 2027, they tell us. Meanwhile, they've got their other two projects. They've got this one where they actually operate that on a 73% EBITDA, earnings before interest, depreciation, and so on. And the reason for that is that they're not actually having to do any digging particularly. It's surface tailings, and they're basically dissolving those tailings into a sulfurous leaching solution, getting the copper out of it that way, piping it all. So it's a very simple operation with good profit margins. I think a lot of the cost really is the actual solution, the sulfuric acid that they're having to use, rather than what would normally be the case where you're digging and you've got the mining cost, the stripping cost, etc., etc., etc. So yeah, chucks off a load of money. It's been paying a dividend for a while. I must admit, I sort of bought into it, sold out of it, bought into it, sold out of it, bought into it. So I think I'm on my third go, and bought in at £1.53, I think it was. So I'm on a small profit this time round, but of course there's the dividend on top. So 18 pence dividend on £1.53 is obviously 11.7%, I think it is. So kind of makes reasonable sense. They've also got a second project, which is SASA, which is the zinc and lead. So that sort of chucks off a bit of money, but it's about a third SASA, two-thirds Coonrad, which is the copper, by revenue, but because the profit margin is so much higher, the Macedonia operation, the lead and zinc, is not a vastly profitable. But overall, when you look at it, it's on 6 times earnings, 5 times if you strip out the cash, because they've got 67 million of cash. So it's always looked quite good value, and a very reliable payer of dividends. And so there's probably the point of this article that I made was that the problem will be that the people that own this share for dividends will probably get upset and harumph and sell it because they want to earn dividends. And then it's whether the people that want to own shares where there's growth, given that the growth from this Antler mine is going to um, triple profits, or should triple profits. It's just, I guess. But then I was thinking about it. It was like, well, if a load of people harumph and sell it, and it goes down to, well, certainly if it goes down below 150, I'll be all over that, because it will be ridiculously cheap. I mean, at £1 today's price, £1 62. I mean, just kind of working through the numbers, basically working through the numbers in the PFS. I mean, obviously these things are never certain, and none of this is advice. But um, yeah, I would say you know it's not hard to kind of get below 2 times earnings, and what that would mean in sort of plain language is that for every pound you put in, um, that's at 1.6, that's 60p a year that it's generating. Now, whether you get 60p of dividend, I mean, that would obviously be if they was just giving like 100% of free cash flow, which is never a good idea because you obviously want to reinvest back into sustaining capex and growing the business. So it's never as simple as sort of, oh yeah, we can just chuck it all off. But yeah, I mean, I could see it at today's price in a couple of years being at something like 20% yield, something like that. If they can pull it off, as I say, it's not certain. So, I mean, um, in terms of what percentage I'd consider a full position, I mean, I would say I tend to not go above. Um, I would say probably a full position for me is about 2.5%. So I sort of, uh, I would say I've got about 45. So I've got some that are like small positions and some that are large positions. Um, but I would sort of go 2.5 in my mind is a full position, and but also I sort of look at it in terms of trading costs, where I sort of say, well, you know, you obviously the smaller the amount that you deal in, and sometimes I see people buying, because you can obviously see the trades, people buying like shares, like £100 of shares. I just think that's ridiculous because, I mean, even if you're on a really good trading charge, you're still looking at £4. So the share's got to move by 4% plus whatever the spread is. And the spreads normally, well, can be what, 5%, 6%, maybe more. So then you've got to make 10% even just to break even. It's not worth, so I wouldn't, and yeah, I mean, the other thing that these small trades will be, yeah, it will be market makers, and they'll be, there's a little bit of testing the water where they sort of put like little trades in to sort of, I think that's some of it. Um, but yeah, I think sometimes there'll be a mixture of things that are going on. In terms of numbers, yeah, so about 45, I'd say. I don't I have gone through and spring cleaned a few things where I've sort of just given up hope rather than hanging on, hanging on, hanging on. I sort of have got to a point where I said, "Do you know what? Like, this is not doing, like, I could redeploy this money." It's actually a very refreshing way of looking at the world when you actually say, "Well, do you know what? Like, I've got a really strong conviction that, maybe like this one over here could double over the next whatever time period, sometimes months. Been had some good luck this year. Why am I sort of, like like there is this sort of blocker, I think, where people don't want to sell at a loss because they're crystallizing a loss. But like, it actually, if you look at what you've got and you kind of go, well, the loss is already made, it's just I haven't crystallized it. Well, just move on. Sometimes the right answer is just to move on, sell it, get rid of it, stop tying up your money, put your money into something that's going to generate an income or generate growth, or both. Um, and this is the thing, like, if you feel that position can recover, then keep going. Like, I'm not saying just sort of sell anything that's losing money. Well, I mean, maybe sometimes that is the right answer as well, is to be very disciplined, and anything that's dropped by 10% or whatever percent you say is like the point of no return, that you sort of just get rid. But I personally, I think that there's so much disconnection sometimes with the markets that you'd be throwing out the baby in the bathwater type thing, that it's I don't have a specific percentage where I would sort of, yeah, just sort of like I sort of was quite critical of, there was somebody else that was sort of like, oh yeah, I've got this 25% rule, and then if anything drops below 25%, then and this was Harbour Energy, where they were like, oh, it's broken my rule, so I'm going to sell it. And I looked at like the numbers, and I looked at the company and what they were doing, and also just like, well, why had they? I mean, obviously, oil prices had been falling, so that was part of it. There was just various reasons that Harbour had fallen. But I was looking at its outlook, looking at its yield, and I was like, this is very tempting. Anyway, I bought, and I think it's about 34% up. So I think having arbitrary rules can be really dangerous, just bad investment practice. But I think equally being very realistic and just very clinical. Don't fall in love with your shares. Just they're stepping stones to step you to a better future. Treat them as stepping stones, not as children. um, so then you don't feel you're slaughtering your children when you sell something off. There, it's just a stepping stone. Well, unless you're a stepping stone fan, of course, and then you probably would feel very guilty about losing your. Anyway, you get the idea. Um, do I think Reeves will come for the banks in October? Now, there's an interesting question. So, banks are doing very, very well. I in my past I invested into Santander, and that at its low point, and it's obviously recovered from low points, as many of the banks did. Missed out on other banks though. I mean, I think NatWest is a great example of a bank that's going great guns. I mean, let's just quickly let's see if we can get that. Can spell it, NWG. Yeah, as you see, I don't really. Yeah. So yeah, over say 5 years. I mean, look at that. You could have bought it back at 100 pence, and you would have 5 times in 5 years, 100% a year. You would have bagged every year for 5 years. That's pretty good. That is pretty good. Um, I mean, one that in this space, I don't have any banks other than I've got indirectly got banks through these guys. Now, I would say, and I would call out that Starling. I haven't written an article about this yet, but um, Starling's 2024 results were absolutely fantastic. They've got their engine business. They've now got one of their two customers has got 500,000 customers since launch. Deposits exceed. You perhaps know better than I what 1 billion lei are worth. I think it's something like 7 or 8 times to the pound or something. So yeah, look, I mean, I think for me, Starling Bank is an absolutely fantastic. That's got so much more, more to go as well. So I mean, if I just quickly grab see if I can quickly grab the um, 2024 results, because they are. I wasn't going to talk about them actually. I did sort of make a mental note not to say, but since you've talked about banks, or we've mentioned banks in the chat, then yeah. So this is the 2024 results. Came out just over a week. Well, I think it's about 2 weeks now. But yeah, you can see. Let's have a look. Yeah, I mean, last year. Well, they say last year their return on tangible equity was 27.7. I remember it as being 31.5 last year. But anyway, it's 31.5 this year, which is a fantastic result. I mean, that is about double of what NatWest will be. I don't think I'm wrong on that. That let me just see if I can find the answer to what is NatWest's return on tangible equity. Let's see if we can get an answer to that. Yeah, NatWest's return on tangible equity 9.4. So Starling 31.5 is absolutely phenomenal. 54% increase in profit. 2.9 million accounts up from 2.4 million accounts. 17.8 increase in active customers. 4.34. This one absolutely blew my mind. The net interest margin 4.34, up from 2.72. I mean, and then you've got the software business on top of that, so they've got two customers and the referenceability. Oh yeah, and of course, you know, leading in terms of customer feedback, you know, far beyond First Direct, which is always sort of known or reputed as being the top one. Well, Starling's higher. Actually, it is number two. So number one, I think it's right in saying number one is part of INOV. So this is another, actually, so yeah, another one where the top holding is actually a bank. So this is the I've covered this not so long ago in this article, INOV tender offer, and no, Starling's unquoted. Its major shareholder is Chrysalis, hence we talking about Chrysalis. So Chrysalis own 20-ish percent, or maybe it may not even be as much as 20%. They own a big chunk of Starling. I mean, as a percentage of the NAV, it's something like, I think they own about 270 million. I last looked Chrysalis here in it'd be a crime not to. And yeah, there we go. Look, they 29% of the portfolio worth 278 million. And I think the valuation of Starling is something like 2.2 billion, maybe. So on the basis it's about that. Yeah, on the basis that it's worth about that. And actually, there's another article that would be good to look at. It's a more interesting world with Starling in it. This one. So, I mean, when I looked at this, yeah, so I wasn't imagining it. 31.5. This is the 2023 results. So, yeah. And anyway, I haven't written an article about the 2024 results. At least I don't think I have. Well, it does say 2024. I don't know. Anyway, let's have a think about that one. So yeah, I've got a feeling that, yeah, the read across valuation. So Monzo's valued at 4 billion, 11 billion of deposits. Starling had a valuation of 1.2 billion. And yeah, Chrysalis hold 137,000 shares of 1.1, so it's 11.6% ownership. So when you consider, when I wrote that article, so Chrysalis at year end, so I think that is at 31/12/24 that I said that it was worth 1.2, or maybe not. Maybe it's yeah, so in 1Q24 it was valued at 1.76. So I think that valuation was at the end of 2023. Yeah, or in fact September 2023. So on the basis in the latest article that it's now 278, 11.6%. I mean, it's about a 3 billion valuation now, but you know, on those kinds of profits, 3 billion valuation, 301 profit before tax. I mean, obviously take off 25%, let's say, for tax. But I mean, you're looking at a PE of 12 and a half times for a bank that's growing its profits by 55%. So like, and actually this is the bit where I sort of would say, well, look, compare it to say Lloyd's or NatWest. I mean, if we look at NatWest, for example. So again, let's just see what the profits have done over 5 years. I suspect the profits will not have increased by 55% per annum. No, not even close. So yes, the share price has jumped, but that's kind of for me where the excitement of the banks is, and I suppose the point is with Chrysalis is because they're going after and swallowing up competitor. It's not as though the pie has to grow. Um, they're just taking more of the pie because they are offering a better service, better recommendation in that in that screen there. That's why they're taking share, is that they're yeah. So profit NatWest in 2020 they lost 500,000,000. 2021 they made, well, this is operating profit, 4 billion. 2022 5 billion, 5.1. 2023 6.1. 2024 6.1 or 6.2. Trailing 12 months it says 6.6. So not great growth of profit whatsoever, and that's operating profit. If we go net profit, it's grown from 3.2 to 5.2 in 5 years. So it's grown by 60-ish% in 5 years, 12% a year. This is growing about 4 at least more than 4 times faster. So yeah, I wouldn't touch any of the banks because this one's, for me, like, that just blows all of the other banks out of the water pretty much. I do like the this one though, the Atom Bank. I do like Atom Bank, and I think I cover it in this article here, masking the opportunity. And yeah, so in here, deposits grew 14%, 32% in net interest income. Operating profit grew by 575%. I mean, again, it's like, well, why would you invest in a bank where profits are growing 12% when this one is growing? And the bit that excites me about this one, by the way, is the fact that they're growing very, very, very fast in India. You can actually look back on my articles where I'm like, I think I'm right in saying this one's India. So they've got I'm doubting myself now. One of them is growing in India. Maybe it's no, I'm muddling. It's because then, yeah, there's a third one then, which is Augmentum FinTech, and I think I'm muddling that one. That's the one that's got its Indian operation. So yeah, this let's see, are we augmented reality? So this one has got, well, Zopa obviously is doing some interesting things, but it's where has it gone? Oh, it's one of these. Tide. Tide is the one that's expanded into India. Oh, sorry, apologies. No, you're right. I have not shared my screen. I'm talking about stuff that I'm showing on my screen, and I've not shared it. Flipping out, pretty silly of me. There we go. That's better, isn't it? Sorry, I've been talking about all these different ideas and not showing anything. So this one is augmented reality, and in here, the Tide Bank is well, you can see it here actually. Tide, that orange line. So over 4 years, the valuation of that's grown from 10 billion to 40 billion, so quadrupled. Zopa, the blue line, has grown from, what was that, about 7 to about 32, I think it is. I think I've actually got the numbers somewhere in all of this as well, or maybe not in this article, but well, I have got the numbers obviously because I created the chart. Yeah, but and then you've got a whole load of other interesting things in here as well. So yeah, Tide. And by the way, sorry, when I say it's 30 billion, 40 billion, I mean Augmentum FinTech just own a small percentage of it. They don't own the whole lot. There's just uh, the yeah, just a small holding, but that's yeah, all three of those. I mean, for me, that for me is the interesting thing with banking. It's the disruption of the banking, and the interesting thing there then is the idea that yeah, you know, it's that digital transformation of what's going on, and if banks kind of enter a down cycle, well, because they are taking share and disrupting, they shouldn't be overly affected, or at least, you know, the other, you know, you'd obviously be more affected in something like NatWest than this. So other articles that I was going to just talk about. Um, just thinking to sort of, you know, cover off some of the ideas that I reminisced on the 2024 fun run. So the idea there was you know, just to sort of say, well, you know, if the ideas from 2024 had carried on, what would they look like today? So this was interesting. So um, this list here from Paul Scott would so these are percentage contributions. So this was based upon an imaginary £1,000 into each one of these ideas, so £20,000. So if you took £20,000, what would have happened to it? Well, you know, £20,000 would have made what, 6,000, just over 6,000 profit. 31.3% of 20,000. So, and a large part of that would have been CMC, Beeks. Now, the one that interested me was Reynolds. Reynolds was far lower 6 months ago. So I think the ideas that have done very well since and in 2025 is Reynolds particularly, and I think Volex as well, because Volex was on a whacking loss and now it's now on a profit. And point eight is referring to the idea that so that would be sort of a zero 0.8 of the 20,000. So that would be £160. So £160 on Volex itself would be 16 percent. So that's kind of this column here, 16.6. Oh, sorry, no, 15.2. So yeah, that 0.8 is sort of the overall, and then that one's how much it's actually gone up by. So yeah, that's and obviously there are still some that are um, doing badly, but lots and lots that interesting to see that some of these that were sort of super stocks are now no longer. They've lost their superness, if that's a word. That yeah, both of these have got sort of question marks over them now. You know, that one ranked 40 as well. There's is and growing earnings, price earnings growth 2 times. So yeah, I mean, I just couldn't see anything unique. I know I've said this before, but I couldn't see anything unique about Beeks. Yes, they've got some high-profile customers, but what stops somebody else copying what they do? Because all they're doing is, from what I can see, is providing servers. And well, the world and his wife can provide servers. They don't have any IP that I can tell. They don't have you know, just reputation and case studies. You know that they can say, oh well, you know, the X, Y, and Z stock markets use us. You know, so obviously that could be a reason that others would want to use them because they want to copy. Um, but I did find that there was an American business that did what they did and kind of had case studies as well. So again, I just worried about following uh, Paul Scott's idea on that for that reason. CMC, I just when I looked at it, I wrote Charlie Mike, Charlie CMC ages ago, and yeah, it's quite. Let's see if we can find that. And I don't think I mean, obviously the price came off after that, but I think at the time, yes, it had tripled. So yeah, Charlie, Mike, Charlie. That that yeah, I just felt it was very expensive, and I think it went down from so July 2024, so that's 12 months ago. So if we have a look at Charlie Mike Charlie, I think it's gone down and then now has gone up a bit in so there's the 1 year chart. Yeah. So I wrote my article back here saying I just don't see why it is as expensive as it is. It's quite highly priced. So yeah, I mean, it looks like I was right on that. Not always right, but sometimes am right. And so yeah, it's interesting. It's interesting. I mean, some of these ideas, um, I did sort of toy with zote foams and thought about zote foams. I have taken a little holding in plexus because at that price, I mean, it's quite interesting. I think if they can succeed with their build out of um, the rigs that they're going to be renting out, and I like the idea of the technology, um but yes, no, I mean, absolutely, when it's like spotting what he spotted. I mean, if I go back in a time machine, if I could have spotted what he spotted, I would have been incredibly happy. And yeah, I mean, Paul Scott should be incredibly happy for um, finding something like that that was just so clearly mispriced. I think the point that I was making when I wrote this article was to say, well, comparing it against the pedestrian performance of um, TCAP, TCI cap, I just sort of said, well, look, these guys are sort of doing. I mean, they're not the same. They're not the same, but there's a lot of similarity. Well, they're both sort of in the sameish sector, and yeah, I just sort of when I looked at sort of just things like cost per employee is quite an interesting. Um, when I looked at sort of other than holdings like Hargreaves Lansdown versus CMC, because I thought that's actually probably a better comparison. Um, you know, Hargreaves Lansdown was generating about 2.5 times more sales per employee than CMC. So there was quite a few metrics where I was like, it just looks very, very expensive. So it proved. And the other thing that I didn't like, I mean, yes, great that they're giving away the service for 12 months, but then I thought, well, how could you be making record profits if you're giving away your service for 12 months? um, but that it felt like they were trying to chase market share at the expense of profits. Now, obviously, market share is good, if you've got a larger market share, and if people stay, but you've got to worry that people would just take that 12 months and then just like a credit card tart, move to another service in 12 months time, having had the 12 months for free. Would they then pay these prices? I don't know. Perhaps some would, some are too lazy or whatever. But yeah, I just wasn't overly keen. I think moving to these to my ideas, Kazira's going great guns. I think I talked about that one here. So um, yeah, I've got a good feeling that when you consider that something of a hopper that size and the spirals, I mean, that is going to be chucking off some money. That is going to be chucking off some money, and that's obviously a quite a small operation, really. And there's a couple of people. I was going to say a couple of dudes, but they might be. Who knows what gender? Uh, but a couple of people that are manning the thing, and it looks yeah, but the proof will be in the financial results. Georgia Capital, when I looked at this, the 32.83. I mean, this has just gone up and up and up and up and up. They've just said that they're going to sell off this 20%. This option valuation. It has been sold at 3.5 million GEL. Or Larry, I think they're called. GEL is the GEL is the acronym or the currency, but it's about £1 million. It's about 3, oh, there we go, 3.7 to the pound. So yeah, another £1 million. Thank you very much for the water utility. So yeah, all looking good. And these valuation, EV EBITDA valuations, 8 times, 9 times, 10 times for these businesses that are just growing like Billio. Yeah, I mean, Georgia Capital's, it's just a great. The thing that sort of, I think a lot of people were put off by was the idea that it's in Georgia and there was the protests or whatever. But you know, businesses just carry on going. They keep their heads down, don't get involved. At least that's what the guy told us. He said, I'm not going to get involved in politics, not interested. We're just, working and investing and carrying, keep on keeping on. Baker Steel, I think, I had to say here, numerous upsides. I mean, if that Futura sale goes through, that will be phenomenal. I track the holdings that, so things like, they've got a large holding in Tungsten West, but they've also got options over Tungsten West. Look what's happening to Tungsten West. So 2.5p, 12.5p. It's a 5-bagger. Yeah. So so Baker Steel is one of the biggest beneficiaries to this. Now, this isn't in production. This isn't in production. You can see there, up 38, up 5.8. The news flow on this. I think Baker Steel's a massive buy. Yeah. I mean, it is up. Baker Steel's up from about 48p to 60p, so it's up by about 25% this year. But I would, well, I mean, look, none of this is advice. It's, you make your own investment decisions. But what I'm saying is that this, because it's got the strategic designation, there's, I think it's either 50 or 100 that are, so the official NAV of Baker Steel is 92.6p, I think it is, per share. And, when you sort of look at the post period, like it's 92.6 based upon the share prices as at, I think it will probably be 31st of May. So in other words, there's all these little tickles that are happening, so the valuation will be based on a price by about here. In fact, if we say, there we go, it's based on a sort of 5p price. Well, it's more than doubled. Let me just grab my Baker Steel, just to sort of show you the degree of movement on this. So bear with me. Right, here we go. So yeah, Baker Steel, I mean, Futura, this is valued at 31 million. And that's sort of made up of the loan, it's made up of the royalty, and it's made up of the direct equity shareholding, this 26.9%. So I think the sale, if it goes through, will be for these two bits, leaving this in place, which is a 2% royalty. And no, it's not. It's a 1.5% royalty. Sorry, apologies. That would still remain in place. Caledonia, I mean, that was trading at about £8. It's now at, I think, £14. So again, let's take a quick look at its CMCL, is Caledonia Mining. So this, again, you can see here, I mean, just how phenomenally, now obviously that's gold price, but yeah, buy it at £8, and today you could sell it at 13.60. So that's a near doubling. It's 70%, isn't it? So again, this is the beneficiary of that. So the holding, I think the holding is, here we go. Now, obviously, these are not up to date. So I mean, if we sort of say, at the end of April, at the end of April, it was worth 3.6. So obviously, since then we've had the May result, but sort of taking between the end of April, which is there, look, it was at £10 a share. It's now at 13.60. So the upside there, I mean, you're looking at sort of 36% of that. So you're looking at about 1.2 million from Caledonia. Now, obviously, I think we'd have to take the value at the end of May, so it'd be this £12.50. But you get the idea. I mean, it's like each period, um, you've got upside. Now, the only one that perhaps won't have massive upside is this one, Silver X. So Silver X is a Canadian or American and Canadian, and it's this one here. These kind of just have perennial bad luck. So you can sort of see, even though silver prices are, well, silver and gold, because that's what they do, it's kind of just static. There we go, over 10 years, over 5 years, and obviously down over 5 years. This is back when there was the last spike. What these guys have to do is just get their production going. It could still perform. It could still perform, but hasn't done yet. But yeah, this let's go back into here. I think this actually is the article. Yeah, so let me just quickly say, this article was where I sort of looked at the Baker Steel. It was, where has it gone? Boom. It was this one, Futura possible sale. So I think this, and obviously that's slightly now higher. I think that's now about 210. But yeah, the deal, if it goes through, will be yeah, $2.38 per Futura share. So what I did was I said, well, they've got this many shares. Okay, so the 238 is, where am I getting 315 from? It's that one there, 238. I think that is, trying to think where that, so the proceeds would be 315. Oh, sorry, apologies. Yeah, 238 was the buy price. 315, I think, is the offer price. Yeah, sorry, that's where I was getting 315 from. So yeah, if this goes through, then stuff that costs 14.86 million. So the convertibles being a loan that can convert into equity. The shares are obviously equity and they cost 12.4 million at that buy price. That's the buy price they tell us about. Now, this technically, as I say, I think the Aussie dollar is this now. So the numbers have changed slightly to 5.4 million, which I think is slightly lower. But if I just go back, yeah, so it's gone from 5.66 to 5.4 million because the Australian dollar has weakened. But yes, if this goes through at that rate, the proceeds would be this. And what I did was I said, well, they would convert the warrants. So the warrants would cost them 200,000 or 190,000, but then those warrants would be sold to the buyer and would receive 300,000. So you sort of, this is where I'm sort of, the convertibles. Well, the convertibles is that there was 2.38 million loaned. That if you converted those, then those shares would be worth 2.96 million. So in other words, there's a 5.4 million upside to Futura if that goes through. There's an upside from the as I say, the various different holdings. And just to sort of focus in on, because I don't think I focus in on it on this one, but the tungsten West. No, it's not in this article, but the tungsten West is worth looking up and looking at, because I'm pretty certain if we go tungsten West, I think it might have been this article here, which was actually about golden metal, or guardian metal as it now is. But what I did was I compared Tungsten West, and well, I compared every tungsten share I could think of actually. So the thing about Tungsten West is that there's convertibles and various different things in that as well. So I think that yeah, and when you look at the Tungsten West resources, just to sort of show you these tonnages, and I think the JORC resource was all based upon tungsten at a silly price. Um, it's a really silly price. So there was a lot. Yeah. So there was 0.26 tungsten versus 0.18. So it's actually potentially got a lot more concentration of tungsten than Guardian Metals, and that would be Pilot Mountain as opposed to the uh, Tempute. But I think it's not this article in this case. It's going to be. Let's try second time. If I don't find it on the second one, you'll just have to go and look it up for yourselves. But I think it might, or it might even be this one. Will you help me? So let's have a look. The Yeah, the MPV is 297, but that yeah, 25% internal rate of return, 2,900 tons, based on a 55 million investment to develop the mine or to redevelop the mine. But yeah, here we go. BSRT is the largest shareholder with a 15.4% holding. In addition, they hold 12% of the convertible loans. So kind of same story as what I'm showing you there for Futura, is that what Baker Steel do, and where Baker Steel, like for me, the thing that excited me was that there was all these little things like convertibles that if the share price goes shooting up, well, you see what's coming, can't you? Like, with Tungsten West, going up in price as it is, it's worthwhile converting the convertible. So with the convertible converted, you'd be looking at sort of 27.4% of the share capital, obviously minus any dilution or whatever, any follow-on fundraisers that they do. That's 27.4 based upon that point in time. Um, I think it was the broker that said they had a target price of 60p. So obviously, again, it's gone up from 2.5 to 12.5. So it's done a five bagger, or four bagger. It's gone up 400% from where it was. But uh, if it goes to 60p, well, it's still got another five to go. It's not there yet. Yeah, and I sort of say here, 60p would be 15 times today's share price. That was back when it was at 4p, which would give you a 35 million upside for Basrat. So yeah, it's there's well, you can tell I'm very enthused about and actually just also to say. I mean, this one has now turned into Blue Moon. If you look at the Blue Moon article, uh, that's actually very exciting as well. I think it might actually be this article that I've written about it. So Blue Moon, 8% of the NAV. So what they did was they sold off Nusia to Blue Moon and took shares in Blue Moon. So they own 11% of Blue Moon. So basically, Blue Moon has got Nusia as well as two other projects. So now Baker Steel is Nusia, Blue Moon, VMS. So they've the company's Blue Moon. The mining project is called Blue Moon, and then they've got this NSG project as well. So two of them in Norway, one of them in the US. Blue Moon share price was up. I don't think it's gone down. In fact, I think it's actually up quite a lot more than from when I wrote the article. So if I, oops, too many oohs in the moon, I think it's just called Moon. Pretty sure that is Blue Moon metals. Yeah, 325 is definitely up from that article. So if we look at what Blue Moon's doing, yeah. So what's it? This article here, May the 10th. So since May the 10th, which is, was it there, 307? So 307 to 325. Yeah, that's up as well. The final one, it's because I'm on a roll. The final one to talk about is the fact that they own um, Prognos, this thing here, and it's a 0.5 to 2.5. So the percentage is based upon the price of silver. Net smelter royalty over Polymetal. Now, Polymetal owned assets in Russia, and Prognos is in Russia, and obviously there's a embargo and various different things but basically what Polymetal did was it changed its name to Solid Core. It divested its Russian assets to who knows who, um, and it kept its Kazakhstan assets. However, the agreement is with the Kazakhstani company regarding the net smelter royalty over the Russian asset. So, in other words, they are on the hook to pay the royalties to Baker Steel. Now, this is currently just not in the price of the share anywhere whatsoever. But I mean, my own estimates were that it could chuck off, well, even at sort of what was current silver prices, 1.5 million. At current silver prices, today's silver prices, that number's going to be much higher. So you can see here royalties of 6.8 is based around Futura. Now, again, that's sort of not today. That's sort of coming in time once they're at full scale. And that one is once Bilbo's is built, once Bilbo's mine is built, Futura, obviously that would disappear if it was converted. That would remain, that would remain, that would remain. That could be a lot higher. And then there's dividends. So Caledonia chuck off about 500,000 a year dividend, assuming they keep going with the dividend. And then the other dividend that again is well, obviously not if they sell, but if they don't sell, there's a dividend potential from Futura. But also CMOS, yeah, this is a cement maker that's just introduced a clinker, which cuts their costs. There's also a second line that they're building. So look, I mean, as for the sort of sufficient liquidity in the UK question, as far as I'm concerned, there's enough smart people with money that invest internationally. You know that I don't think. I mean, obviously, it has been a source of disconnection, but I'm seeing a quite a different market compared to last year in 2025. The Yeah, I mean, there are discounts out there, and I'm not saying discounts will disappear. Baker Steel's on a discount. I'm not saying that discount will necessarily disappear, but I mean, certainly if they sell this off, I mean, all of a sudden there's a bucket load of cash that is going to go somewhere. I think it would be something, yeah, proceeds of 20 million. I mean, this is a 50, 60 million market cap. So it's about a third of its market cap would be arriving as cash, approximately. I think it's under this one that it will tell you that it is 66. There we go. I wasn't far off. It was sort of 60, but the price of it's gone up, making it so yeah, buy price of 64, but the NAV price I'm pretty certain is 92.6, but let's just quickly double check that. And yeah, there's all the obviously the different holdings. That's how much they have changed since the end of last year. So Prognos is like hidden away inside that 1.7. So yeah, I think that um, where is it? Yeah, there we go. 92.2 pence. I don't think I said 92.2 pence, but anyway, that's what it is. Yeah, obviously quite a discount from, well, even paying 64. What I've tended to find actually is, even though it says the spread is that, when you come to buy, you'll probably find that you're buying at 63 or 62.8. There tends to be a sort of a wider quoted spread than actual spread. Um, okay, so what do I think of Hannah, which will end up buying OCN? Oh, Hansa. Yes, Hansa. Yes. Um, well, look, I'm. Yeah, this is an interesting one for me. Hansa is okay. I think it pretty much is the same animal as Ocean Wilson's, or Ocean as it I guess it now is, because obviously Wilson's is gone. Um, that Yeah, I think the news about the amalgamation's positive. I think the tender offer is very positive. It's an interesting one as well, because if you take the money, let's just quickly chuck it up on screen. Let's chuck it up on screen. So it's a very interesting one, because if you take the money, there's a guaranteed upside. So it's yeah. So you could buy 15. I bought some more this week. At I think I paid 14.90. So I sort of bought slightly below that, but I have added, because there's just guaranteed upside. So um, this tender offer. So it is a little bit complicated, but what they're basically saying is, you can either take a guaranteed upside. So the lowest amount that you'll get is 1543. So obviously that is above that value there, and obviously there's no trading cost. So you'll literally get the cash. At 1543, this will be very accretive. Now, I covered this in this article. Actually, just show you the spreadsheet's probably a better way of doing it. I might even be able to sort of show you how much how accretive it will be at different prices. I might be able to do that. Let's see if I can. It's yeah, this so this was kind of what I wrote in an article, and it was quite funny, because I can remember there was somebody that said, "Oh, load of rubbish! They're never going to do a tender offer." And I was like, "Well, here we are. Yes, they are." And I sort of said 20% above today's market price. So I think that was based upon where am I getting 13.7 from? It was based upon the share price at the time was 13.7, and 20% is the 1.2. So I was sort of saying, I think they're going to tender at 1644. Well, I wasn't far off, because like halfway between that and that is pretty much 1644. And I've got no connection with these companies. I'm not in conversation with them or in cahoots or anything of that nature. I just sort of said 20%, and that's sort of how it's fallen. Now, it will depend upon, it's almost like a game of double bluff or something, where if everybody elects to go for that one, then basically it'll go through at that price. If it goes through at that price, let's change this. If it goes through at that price, that would be the tender value. I was going to say this should all change, but it's not changing. So I think so 20% of the shares would be that. Yeah, I guess the thing that will change is, so you would get that many investments left, you would get that many shares left. So all of that's fixed. It's this bit by here, I think, where it's getting that from there. I'll have to think about this. But yeah, I mean, obviously, at different share prices, then that's going to sort of reduce this cash remaining. I think this cash remaining 21.23 minus the D25, which is that one there. Yeah, I think the cash remaining will obviously change depending on the price that it goes at. But I mean, even at that, well, look, this calculation here that it will boost the NAV to £21. So that is based upon a 1644 price, which is midway. So basically, if you let's just change that back. So if it goes for higher, then obviously the people that are tendering get a higher price. I mean, at 1736, if everybody, if that is the price that everybody chooses, um, the then basically it'll go through at a guaranteed, £2. And actually the other thing to say is because the majority share owner has said they're not going to involve themselves in the tender, like 60% of the shares are not participating, that it's only 40% of the shares that are participating if they want to. So what that means is that that's kind of then half of all the shares that are left. Now, obviously, some people are going to sort of say, oh, no, I don't want to sell. They're going to sort of be greedy because obviously there's upside. By what I was sort of saying with this calculation is like, well, the people that are selling out at £16 44, in my example, they're basically sort of going from owning, so the NAV was based upon the sell price of Wilson's was 1941. So you're getting about £2 upside based upon people accepting a lower price. Now, obviously, if that lower price is 17.34, then it's going to be a slightly lower than 21.23, but it's not going to be, it might be like £20.80 or something, £20.90. So it's not going to be vastly less. So the idea of the guaranteed upside, I was like, well, this is just sort of, yeah, like, why? Because you win. I suppose the thing about it is you win if you trade in if you tender your shares, and you win if you don't tender your shares, um, on the basis that the NAV goes up for those that remain. Now, what's the right thing to do there? Well, depends on whether you want to turn the cash quickly or whether you want to hold on, what you feel about what the discount will look like, what the merger will do. I mean, I think the idea, the other thing I would say about, because obviously people sort of say, oh, well, because it's got a very bad long-term record, and sort of let's quantify what I mean by it's got a very bad long-term record. What people do is they point to the idea that, well, over X period of time, so you can see it here, yeah, actually these numbers are sort of, over, I think it was something like over 10 years, maybe it was over 10 years. Yeah, so £9, I mean, up until quite recently, obviously it's gone up a lot, but up until quite recently, I mean, you could buy this. I mean, I remember buying it at below £10. Yeah, so like, just like a year and a half ago, or even here, like here, you could buy it at say £12 or whatever. And I suppose the criticism was, well, it's hardly gone up over time. Well, I suppose over 10 years, it's gone up, what, 60%? So 60% in 10 years is about 6%. So people sort of point to that as the reason that it's rubbish, because it's only delivered 6%. But what you've got to also remember is that over 10 years it's chucked off a lot of dividends. So you've also got to take into, well, there's only 5 years, but what you've also got to kind of take into consideration is that they have, there we go, total dividends. So on top of that 60%, you've also got to kind of take, what's that, 350, 460-ish over 5 years. So there's another 90, on average, about 90 cents. So that takes you to $20. Obviously the tender offer will take it to 20 anyway, so that takes you to $25, and that's over 5 years. So actually, let's do 5 years performance. 5 years performance is 123%, plus that you would have had $4.50 of dividends, which is another, say, 40%. So that's 160%. So when people say, oh, the performance is terrible, blah, de da, de da, well, is it though? And actually, the other thing I would point to, and it was this, it's only when you sort of start breaking out the data and looking at it where you say, well, hang on a minute. Obviously some of this stuff is pretty pedestrian, and like over 18 months, a lot of this private stuff has not performed well. It's been poor. But what I noticed was what they termed the new private equity. So this was sort of private equity into US, so US mid-market buyouts. Whereas the stuff that was sort of Latin America and the Philippines, which is this stuff here, it hadn't performed terribly well. Now, maybe in fullness of time it will improve, or maybe it's just rubbish, and but the newer stuff, the newer private equity, genuinely was returning 20-ish% per annum returns. Now, the obvious thing to do there then is to sell more, to invest more into the 20% stuff, surely. I mean, and obviously keep it with the mix so that you've got the hedges and the different things going on as well. So there are so some of these, I mean, you wouldn't be able to, as a private investor, be able to access them directly. I think, again, what people point to and what people focus in on is, well, because I can buy Pershing Square Holdings on the stock market, which of course you can, and because I can buy iShares Core MCSI Europe, yeah, that's the reason that it's. But even some of these that are like public, so publicly listed, this, for example, is only listed in the US on I think it's over the counter. It's not all that straightforward, even though they are publicly listed. They're not that publicly listed. They're not UK publicly listed, and then the stuff that's private, privately held. I mean, some of these you just have no way to access these funds other than through Hansa and Ocean Wilson's. So, I mean, obviously you've got to take a view on that and whether it's, whether you like what they're investing in. But I mean, I've looked recently at KKR, for example, phenomenal returns. They're really chucking off, 20% growth easily. There's some that are really, really high performance, some that are, you could just go and buy them yourself. That's true, but not all of them. Only some of them are actually accessible. And so I suppose I like the idea that it's always a good idea to have some diversification, and obviously this with its financials and Latin America and sort of different parts of the world. I kind of liked the fact that it's a bit uncorrelated to other things. So if mining and gold or different things suddenly don't do well, then this is a bit of ballast in the tank where it pays a nice dividend. They love their dividends. So I must say I quite I'm happy. I'm happy to hold this and take advantage of the fact that there's the tender and not to tender myself. But I'm sort of, I mean, I am tempted by the tender just because it's short term, like within about 30 days, I think it is, that you'll get the cash. It's not, you're not tying the money down for very long to get guaranteed um, a guaranteed result. But obviously, the guaranteed result, say at 15, 20, is not vastly higher than this price, so the arbitrage has dropped. But that's if it goes through. What you'd have to have is a lot of people that are happy to go for the minimum. Whereas, I mean, when I've seen these kinds of reverse auction tenders before, I was surprised by how many that went through at 1736. You know, people said, no, 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 give me the maximum. I mean, it's kind of like I'm trying to think. It's almost sort of like beggar thy neighbor. You know, like whoever sort of goes one lower will get the money, and the one that doesn't. But the thing is, well, is like if you go for the maximum 1730. Actually, maybe this will be my strategy. I'm talking aloud here, but I mean, if I say, well, I'm going to go for 1736, if I get it, great. I've made a guaranteed £2 a share. If I don't get it, great, because it will have gone through at a lower price and therefore the NAV accretion is higher. So holding on, I now own something that's worth 21, 22 quid, whereas before it was only worth 20 quid. So you know, I've gained that way. Um, I think well, no, my understanding is the tender is for 20% of the shares, but you can tender all of your shares. I'm almost certain that that is possible to do. That's where I get the 50% from, is that 60% of the shareholders are saying we're not doing any tendering, we're staying out of it. We are the majority shareholders. We're going to keep our shares. Thank you very much. The remainder, the 40%, they are the ones that can opt to do the 20%. So if everybody opts to tender, because as I say, some people won't, because they'll say, oh, well, you know, like the NAV will go up by other people tendering. So 40% get 20%. So that's like 50% of all the shares will get tendered. 50% of the shares that are not in the Solomon family sort of, or the owners of the business, you know, the majority owners of the business, it's the remaining 40% that have the option to tender. It is in this somewhere in here that it'll say, yeah, like it says it here. Look, effectively, the offer is being only made to 40.3% of the shareholders because irrevocable undertakings to not tender any shares from these people here: Christopher Townsend, Victualia, Hansa Investment, and effectively only 40.3 are being, so technically it's slightly below 50%, but it's, do you see, it's like, so pro rata, if everybody tenders, you will get 50% of your shares tendered. If only half the people tender, all of your tenders will go through. Yeah, so you know, like, to my mind, it's like it's a no-brainer, and that's why I put more on it, because I was looking at it like, I was like, well, hang on, like, if it goes through, you win. If it doesn't go through, you win. Um, and the share price at the, you know, you would kind of think the share price would have gone up to reflect the sort of the arbitrage opportunity, because that's what I believe that this is. But anyway, um, I'm conscious that I'm at an hour and 15, and I was just going to do a short video, and the short video has now become a long video. But look, I mean, there's none of this is advice. It's all you know, you make your own investment decisions, but there are some opportunities out in the market, I believe. It's just my opinion. You know, you make your own decision on that. But I think Baker Steel that we've talked about. I think Ocean Wilson's that we've talked about. I think the banks and the you know, the three Chrysalis, Augmentum. I mean, Chrysalis is on a about 25-30% discount to NAV, but I would question that NAV is not heading higher because of its holdings going higher. Augmentum's on a vast discount. I mean, you can buy that at about 98p, 99p, and the NAV is about £1.62. And then the final one is INOV, again, another arbitrage opportunity. Now, they are genuinely only doing 20%. Oh, sorry, they're doing 21.43%, I think it is. and that's available to 100% of the shareholders. That one probably will be a pro rata, but again, depends on whether people take up the offer. It is being done pretty much at NAV, but what I pointed out in my article was the idea that, well, hang on, it's being done at NAV, but the NAV, once again, it doesn't really reflect all of these sort of hidden values. Depends on whether you agree with the hidden value. Of course, you might say, well, no, it's unlikely to happen. But there's the Araris potential distributions, the Anthos potential distributions, the Carmot. So these are three companies they've sold where there's sort of, if these three do well, then there's sort of follow-on money. Revolut, I believe, is worth every penny of the 45 billion, is my opinion. If that's true, then there's a £1 million upside for INOV. Atom Bank, I sort of in this article explain about the read across upside to what other companies that own Atom Bank say they value it at. Well, INOV are valuing it at a discount. So this 21p, this 21p kind of doesn't really take into account any of these things. So this, sorry, let me just move. Yeah, that market cap of 102 million is theoretically um, worth a lot more. Now, some of that sorry, no, that's the market cap. The NAV is based upon these three things here: life science, venture, and growth. So this is sort of 120-ish million plus the cash is 170. So I think there's about 20 something million upside. So I sort of got it to I think I got it to 33p, which is this. And that was based upon that was based upon these upsides here. So anyway, that's probably enough from me, but gives you some thoughts and ideas. I'll be back Oak Bloking in just over a week's time. So that's it. Cheerio from me. Cheerio.